if it's really what it is, what I think it is, then we are really at the forefront of this revolution, not just financial infrastructure revolution, but also mental revolution.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Bohemil, aka Bob, you're the founder of 319 Capital. 319 Capital is a multi-strategy fund of hedge funds in the digital asset space. You have a deep background in finance at firms like Rothschild, Silver Lake, HG, Letter One, and more. Additionally, you are also an investment partner at the crypto fund FBG. All right, Bob, how did you get started in crypto? Because obviously you have a very illustrious career in TradFi. So why did you decide to make the jump into crypto?
Hi, Andy. Thanks for having me. Really appreciate it. Been a fan of the show for a while. Great question, because as you said, private equity and hedge funds doesn't, at least initially, lend itself to crypto. I got introduced to crypto in 2016 when I was spending time in Asia. I was actually doing a trip from Hong Kong, Shenzhen, up to Beijing. And in Beijing, I got introduced to Jihan, who's the founder of Bitmain. Probably a lot of people know the S21 miner. I approached it first mostly from the, call it traditional private equity, right? Look at cash flows, etc. It was more of a technology focused, not necessarily call it for the store of value. In 2017, started to then buying Bitcoin, Ethereum, participated in probably 30 different ICOs. And then in 2018, actually ended up joining a crypto fund, as you mentioned, FBG Capital out of Asia, focusing on both the L1 tokens, but also the equity side, the digital infrastructure around crypto, kind of replicating the traditional infrastructure. Continued the journey in 2021, then started to allocate capital, my personal money, to Quant hedge funds. I'm sure we will talk about it in a second. And then in 2025, earlier in the year, actually decided to launch a fund of funds that aggregates a number of these strategies. But there's a common thread of being quant systematic focused funds. So quite a journey from the private equity space, doing 2 deals a year, 3 deals a year, to allocating capital to funds that trade, million trades a week sometimes. But going back to your question, like what motivated me? At the beginning, I was really coming at it from the technology perspective, meaning like I started my career at Silver Lake and HG, which are software private equity firms, investing in companies that build software, for example, for finance, for accounting firms, for ERP, which are to some extent database businesses, right? And I was back in 2016, 17, I was thinking, how is this going to disrupt what we are investing in, which is really a database, a ledger of transactions that you then build on. And quite quickly, I realized that's probably not going to be the case, at least not very quickly. But I thought there's still something to it. You can exchange value, you can send money without going through banks. And that was sort of then the natural evolution also to go and think about store of value and think about how else can Bitcoin specifically be part of people's lives.
Very cool. All right. So how was meeting Jihan Wu? I mean, he's an absolute legend within the crypto sphere. I think he was, I don't know if they were the first, but they were one of the very early people or groups to start developing ASICs in a major way. I don't know about his company today, but I don't know how active he is in his company today, but I know he's done exceptionally well, and people are still using his miners and they're working great. So tell me about, that experience meeting him. Were you blown away by him, or was just another tech founder that was building something interesting? Or how was that experience?
Great question. So in 2016, when I met him, it was the summer. And I remember basically him straight away bringing me into the server room. And I just remember this massive noise and heat coming from the servers. Basically, they were already mining Bitcoin back then and testing the equipment that they obviously became selling. But back then, Bitmain was still a relatively small firm, right? They ended up growing obviously massively over the years, but it was not a huge firm. And Jihan back then, a normal guy, right? So yeah, it was very, very hot. And then, Jihan, very normal guy, super nice, showed me around. We discussed, I remember talking about the different nanometers and size of chips and things like that, which ultimately matters a lot when you do Bitcoin mining. But he was a normal guy. A lot of things obviously happened since then. It's been a while. But back then he didn't strike me as someone who has any negative impact on the digital asset space.
Very cool. Okay, so you went from allocating personally and then increasingly got more and more excited and decided to launch 319. I guess at what point were you, and also actually going back a little bit, I want to ask about the reputational risks that were involved entering crypto, because you were involved personally from 17 and kind of going forward. But when you decided to jump fully into crypto with FBG, were there reputational risks back then? And then how those reputational risks changed today? From a standpoint of your friends in TradFi, where they're like, Bob, like, why are you doing this? Or how is that played out?
Yeah, absolutely. I think 2018 was a very different space to what it is today. BlackRock coming in with the ETF massively de-risked the space. And I would say, or maybe argue, if you don't have an allocation today, you are an outlier. It's maybe a carry risk not to have any allocation, right? If you have zero allocation, that means you're taking a view is that overall Bitcoin or the space is going nowhere. Back in 2018, I was at a point in time when basically I was working for a private equity firm, buying software businesses, and I did have certainly some friends who were like thinking, Bob, what is it that you're doing? Like, why would you sort of not throw away the career in private equity that you have, but why are you spending time on such a tiny industry that very often, quite frankly, has been used by scammers or money launderers? That has been the narrative back then. Has changed a little bit. Not everybody sort of got their head around, but a lot of people were approaching it as a sort of dirty word, right? Crypto or Bitcoin. People didn't do the homework on what does the technology do. I would say media, banks haven't really done any favors to the industry. And today, as we know, regulators have not done either, right? Really overextending their sort of power. So back then, coming from a very established private equity firms like Silver Lake, HG, that each of them have 100 billion AUM these days, it was a carry risk. But I thought, when I was looking at the talent and the people that were in crypto back then in 2018. It didn't strike me as a sort of crowded industry, right? Private equity already in 2018 was getting a very, very mature champions of buying businesses from each other. So, obviously at the beginning you start buying businesses from founders, and as you go on, there's not as many good businesses, so you end up buying companies from other private equity firms, which then obviously to some extent can drive up multiples, etc. But the good businesses, you want to be invested there. And in crypto, you didn't have that, right? Everything was new. Everything was untested. And a lot of top quality people were not in the industry. And I really thought, okay, this is me coming in day one, because you didn't have, people with private equity or with hedge fund expertise. And you see it also sometimes in the teams, right? They for example, on the quant side, even today, many of them are not from the top names that you would expect, from Citadel, Millennium, etc. They are kind of self-taught. And so that risk was there, but I was like, look, it's probably worth taking it, because if this really takes off, and if it's really what it is, what I think it is, then we are really at the forefront of this revolution, not just financial infrastructure revolution, but also mental revolution.
Yeah, and why the focus on quant strategies for 319 and kind of hedge funds? Because obviously you were at a hedge fund, so you had experience there, but I guess the bulk of the career, we could call it, was in PE. And PE is more long-term oriented and not quantitative driven. I mean, obviously there's data and a lot of quant related things used, but it's not at all which kind of the strategies that you're investing in today. So how did you decide to pursue that? In addition to that, you've been in crypto for quite some time. And so I would figure that, okay, Bob understands crypto. He's bullish on it long term. He must want to go really long, kind of the asset class as a whole. But market neutral and kind of these more shorter term strategies are kind of less venture-esque and more trading-esque. So yeah, tell me about the decision to pursue that.
Yeah, that's a great question. And there's different ways how to think about it. So personally, I'm long. Don't get me wrong. But when you think about private equity, you do maybe 2-3 deals a year if you're lucky. And these deals, you need to really research them really well, and you cannot afford to make a mistake. But mistakes still happen, right? You invest in the wrong management team, regulation changes. I don't know, a competitor comes up with a better solution for what you're doing, and suddenly your investment can be quite at risk. So you're taking kind of a really concentrated bet on one particular business because it can be probably 10% of your portfolio, something like that, right? In quant strategies, some of the funds, they literally do 100 million trades a year. So you can afford to be wrong many times over the period of one single year. You're not stuck with the investment. If you invest in the wrong business, as you would do in the private equity space, you're kind of stuck with it. You better make sure that it's the right one for the next 5, 6, 7 years sometimes. And you need to work really hard to at least get your money back. In these quant funds, the advantage is if a strategy is not working, you will very quickly know if it's not working. And you can basically stop the trade or stop the strategy, go back to the drawing board and reinvent yourself. And you just don't have that opportunity in private equity. Nonetheless, I do give credit to private equity where the credit where it's due is that in terms of alignment of interest, it's one of the highest, right? You are the owner of the business. You can do whatever you sort of necessary or see fit. So I think that's one reason why quant funds are interesting, because you are not as concentrated. And second, and I think maybe today is actually a good day, S&P 500 hit all-time high, is the directionality, is the correlation with the market. If you buy a business, you want to grow with the market, you are there for the directional exposure into the market. Now, focusing on quant funds, you don't necessarily have that. You might have it, but not in the market neutral space. So let's say, you buy a business, it's a large business, and it depends on the overall macro environment, how much people are buying, what is the unemployment rate, what are the interest rates, right? You are exposed to the market. When you look at kind of the bellwether, all-weather, absolute return, market neutral strategies, different names for the same thing, you basically are trying to not take directional exposure, not take directional view where the market is heading. You should be making money if market goes up or if market goes down. And when you think about that, sure, in some years, you will not make as much money as S&P 500 just did, 25%. But in 2022, when market S&P 500 again, or even Bitcoin, for that matter, went down 20% and 60% respectfully, you're not losing the money. So you're protecting your downturn, your drawdowns, basically. And look, it's not sort of rocket science, or it's not kind of the golden strategy, because you might be sort of giving up some upside. But when it comes to the drawdowns, these should be really limited. And again, can get into in a second to the different strategies that we allocate the capital. But on a portfolio level, these drawdowns should be really minimal.
Very cool. Okay, so that makes total sense. All right, so when you're designing 319, you were looking at a couple different strategies, and the three that you settled on were delta neutral, the short-term directional, and then the DeFi protocol. How do you call that last bucket? The DeFi bucket, or what do you call that?
Yeah, you can call it DeFi bucket. Again, different names, but very often you would not be doing centralized exchanges. You would be on decentralized exchanges and smart protocols.
Very cool. Okay, so talk to me about these three strategies, and then tell me why did you have these three specific strategies when there's tons of different ways to slice and dice this?
Yeah, absolutely. At the risk of sounding a little bit boring, we don't like drawdowns. No one likes drawdowns by definition. But I think you need to be very clear at what is your proposition to the investors, right? If you're there for max vol, go levered Bitcoin, if that's sort of the strategy, if you sort of think you can time the market. We're saying that we don't know where the market is today. We don't want to take a view on that. We don't want to time the market. We rather develop a portfolio that really is agnostic to where we are in the market, right? I don't have a crystal ball that I could tell you, okay, market is going to go up or down next week. when you think about, back to my point, S&P 500 being at all-time high, there's a decent view is that maybe in the next year we will be stable, or maybe we will go down, we will go up. Literally very difficult to call. Valuations are at pretty much all-time high. And so by constructing a portfolio from funds that do not take this directional view or take it very, very selectively, actually enables you to not be correlated to the market. So the 3 or 4 key buckets, exactly as you mentioned. So delta neutral, the market neutral, you could say short-term directional, and then the DeFi space. Already by selecting funds that fall into these buckets, you make yourself quite agnostic to where the space is heading. Sometimes the more vol is better, but not always. Again, we'll get to that in a second. So by having a number of funds across all these buckets means that any drawdown is probably outweighed by positive performance somewhere else in the portfolio. And not everything works at the same time. So when you think about the market, what has been happening, let's say over the last 6 to 12 months, delta neutral, so that's really arbitrage between exchanges, market making, you could say basis trade there. Basically, you're not exposed to where the market is going at all, right? Because you're taking maybe really opposite trades. That has been very, very competitive. The market making space is very competitive. You have very large traditional players coming to the space because suddenly it become decent size. The second bucket, the market neutral space, can be volatile. What I mean with that is, again, is most likely some sort of multi-factor model that determines what to trade and how much. And even if you are 100, so 100 long, 100 short, or even if you have some slight bias, speaking of short-term directionality, you're not correlated to the market, but you can literally be losing money in a particular month, right? Given how volatile it is. The third bucket, the DeFi space, has performed quite well over the last 6 to 12 months. You know where you're heading. You know what you're going to get at the end of the month. You take a little bit of kind of venture risk in the sense that some of the tokens that you will be getting or vesting at the end of the period, they might be higher price, especially if the performance and the market is skewed in a certain way. And that means that you end up somewhere between 15 to 25%, but you have the predictability. So you can kind of, go, okay, I'm going to be allocating across these 3 buckets. I'm going to have 3 to 4 teams in each of these buckets, because again, not all the teams perform all the time. And this as a package, as a portfolio of funds, performs really well. And when I say really well, we're not going to be presenting 100%, right? You need to be very, very thoughtful what you tell your LPs. But if you are ending up anywhere close to 20% on a consistent basis year over year with a sharp over 90 to 95% positive months, that's what I'm saying. We're quite boring, right? We're not trying to be there and to show some crazy returns. We're there more for the boring side that outperforms without drawdowns.
Amazing. Okay, so the first bucket, can you talk to me about the sub-strategies that make up this delta neutral market neutral bucket? I assume like the majority is market making, but are there any other sub-strategies that the folks, the managers that you're investing in are pursuing? And then, how competitive is that bucket? I feel like you just mentioned there's the big players coming in, Citadel, Jane Street has probably been in for years, but like, how is that going forward? Do you expect the alpha to compress there dramatically? Or talk to me about the sub-strategies and then kind of the long-term view.
Yeah. Let me take you on a bit of a journey, actually. So this entire space literally started people having 2 screens and pressing the buttons nearly at the same time manually, trying to buy and sell across 2 different exchanges, right? So that means you need to have money and assets across 2 different exchanges, but you can take advantage of couple doors difference. First manually, then people obviously introduce algos. And today it's a proper HFT, high frequency trading space where you are market making, market taking. It depends how you sort of design it, but across the board, basically you're taking advantage of the inefficiencies, tiny price differences, right, across the markets. Very often centralized exchanges. More recently, when you see some interesting liquidity, also decentralized exchanges, but it's sort of the same trade or the same strategy. And because it is, you're not taking pretty much any risk, trading risk, you're taking operational risk, but on the trading side, you take minimal risk. it attracts a lot of attention, right? It's not rocket science. And so obviously historically, because of the liquidity, only smaller crypto funds were doing this. Later on, you had bigger crypto funds and you had your traditional space. And these days, what has been happening is that some of these funds, they are literally closed to new capital because it's becoming so competitive that basically it makes less and less money. So people want to protect their returns, both either for themselves, as in being principals in the firm, or to investors. And the way to solve it is literally you need to close the fund. So it's sometimes difficult to even invest in some of these funds at scale, right? If you run 5 million, then probably you're not really constrained by that. But if you run 800 million, like some other some other funds where I'm invested, then it becomes a tricky. Basis trade is one of the strategies. That means basically you're looking at spot versus futures because there's basically no delivery risk or minimal delivery risk. And then you have obviously market making, which is the big chunk of that. There's some other strategies that you could count in that, but that's sort of the key, the bulk of strategies. Yeah.
Are you concerned about and actually, here's another question. Are the main players that are entering this market making kind of delta neutral, market neutral space, are they TradFi players entering crypto, or it's just the current players that are crypto native are just filling up or making the markets very efficient, so the alpha is being compressed there?
You see both. So you see literally 5 million AUM tiny funds that probably run some sort of SMA model. So they are not even the funds, are basically running SMA allocation. You see larger funds that have been present for quite a long time. And you see the TradFi, you may mention some names, there's many others. I would say if you don't have the technology, if you're not fast enough, you probably quite quickly know that whatever you're doing is not working. And that's why you will try to go into stat arb. I don't quite like the stat arb, but basically slightly directional, could be long short, but where you're not competing on speed, where your trade is open for minutes, hours, sometimes could be days. But that's where you have your edge based on your models. That's where a lot of people are kind of expanding to. But yeah, you see everyone being there. And look, even if you have a small AUM, if it's your firm and you run a few algos, you can be very well off at the end of the month. And I guess it sort of mimics what has been happening, obviously, in traditional infrastructure, right? I mentioned Silver Lake invested in Virtue Financial, one of the largest market makers in equities, in FX and fixed income. There are some huge firms like XTX in London that just trades FX, for example. And you would think that, there will be, in 2025, there will be no inefficiencies. It will be same price everywhere. But these persist, right? And that's why, for example, when we're going to talk about portfolio construction, like it does not necessarily make sense to entirely divest from market making or HFT, because clearly the inefficiencies will still be there, and you will always find new ways how to trade spot versus futures, spot derivatives, right? You can be trading options on Deribit and then hedge that on OKX. There's a lot of things you can be doing, and that's, I think, one of the reasons, again, it doesn't make sense to divest from any of these buckets.
Yeah, and also if we are correct in our what most people in digital assets believe is that everything's going to be tokenized. Not everything, but a huge number of assets will be tokenized. That the market surface for the area surface for market making is going to expand dramatically from here. So that'll be hopefully it'll be very alpha rich for a very, very long time. All right, so second bucket, the kind of short term directional trading. This is like where I know the least amount. So you mentioned it before. It's kind of this mid to low frequency quant driven strategies. Could you describe, kind of in more detail that bucket?
Yeah, absolutely. So, I mean, you nailed you hit a nail at the head. Short-term directional, basically you're not there competing on speed. You're not there to be the fastest in the market, but you're using some sort of model that then informs your trading decisions. Very often it's a multi-factor model where you take into consideration, obviously, price development, volume, could be the weather, right? Anything that you believe or that sort of shows that there is some correlation with sort of historical. That's why sometimes people call it stat ARB. Some people call it short-term directional. But very often, basically, you are taking statistical data and that then inform your trading decision. You will hear terms like trend following and mean reversion. So trend following and mean reversion are some simple strategies that basically, based on historical patterns, tell you where to place the market or place the bet. Good example is sell in May and come back in September. Super simple, because, for example, there's a bit of a weakness in the market over the summer months when there's less liquidity. Another would be that simply, if a particular price went up by X%, there's a 90% chance that over the next X time period, the price will continue to go another X%. Basically, you're using statistical data to come up with these models. That means you're directional, right? You are betting where the market is going. You are looking where the PUC should be in X amount of time. And that can be 5 minutes, could be rebalancing 15 minutes, could be much longer than that. But you're taking a view. You're taking a fundamental view is that the market will go in a certain direction. And when you think about what it means for your volatility, you actually short vol, because you are betting that the market will sort of keep going where it's sort of supposed to be going based on historical, again, data. So you are short vol. In the first bucket, delta neutral, basically the high frequency trading, quite frankly, you are long vol, because you want as much not just volatility, but also volume as possible, because that opens spreads and that's where you can benefit. So these strategies, to some extent, they are counter, they stand in opposite to each other. Which, again, if you have both of them in the portfolio, that's then you can benefit no matter where the environment. If you are in a calm environment or if you are in a highly volatile environment. And I guess what I see on the ground is that quite a lot of funds are shifting away from competing on speed to employing and really refining a lot of these short-term directional models, multi-factor models, to estimate where the market can be. I think that can work. I think it works really well, but you need to be ready for some months when it's not +3, but -4 or similar. And that can be for a number of reasons, right? Trump comes up or other world leaders come up and they put a tweet out, and suddenly the market goes up or goes down. And you can be caught sort of red-handed because you haven't rebalanced yet. You're not rebalancing as often, or your model didn't catch it. And you can, for whatever reason, you rebalance at the peak or at the trough, and you will be sort of whipsawed, right? And I think that's what we saw quite a lot of in Q1 this year. That's HFT stuff. HFT trading strategies benefit from that rather than sort of being caught off guard. Yeah.
Yeah, no, I was thinking about that. The second bucket of the kind of the short-term directional has to be impacted by, by Trump tweets and, just kind of maybe his family tweets and whatnot. Because if you're looking at, historical data and there's some 10 out of 10 times this action happens after so-and-so whatever behavior. And then Trump tweets, hey, Bitcoin is now, reserve currency of the US or whatever. That'll kind of totally screw with this kind of strategy. So how has that strategy, that bucket, been performing specifically since Trump's been elected in November? Has that been performing well or not as well?
Yeah, it's a mixed bucket. So I see funds that are basically negative on the year. I see funds that are flat, and I see funds that done 15% year to date, while still sort of taking minimal directional risk. I would say this bucket is one of the most volatile, if you want, from that perspective. We should talk about options a little bit, because they will sort of still fall into that. Options is not sort of linearly directional, but you can, and depends obviously how much you hedge and what you trade. But that sort of behaves in a similar way. When there's volatility, the price of these options, calls and puts, doesn't behave in a sort of linear way. And hence I've seen funds that because options are sometimes or very often priced quarterly. They, for example, ended up quite negative in Q1, end of March, but then they recovered pretty much everything in Q4. So in April, in the fourth month, right, of the year. So I think people need to be more patient. People need to have more strategies in their sort of tool or in their portfolio than just one. But back to your question, in terms of sort of performance, I would say the first, which means the delta neutral, and then the third, the DeFi space, is probably in terms of visibility the most predictable market. The long short, pretty much by definition, is more volatile, but can outperform if you get it right. Can outperform the first and the second bucket.
Cool. So I want to talk about bucket number 3, the DeFi bucket. So is this similar to like what RE7 and MEV Capital are doing, where they're speaking with protocols, they're being early liquidity providers, they're getting bonuses from that, and then they're also doing other kind of very DeFi native activities, such as like, I don't know, going on Morpho and being a curator of a certain strategy, or like what is in this DeFi bucket?
Yeah, again, you hit the nail at the head. That's exactly the bucket. So providing liquidity to nascent protocols, and basically locking in value for these protocols so that they can basically vote on transactions or process transactions. There's quite a few other funds out there. There's obviously Edge Capital, there's M1. There's quite a lot of teams because the barriers of entry to some extent is not as large. What I mean with that is, if you are in delta neutral and you high frequency trading, you need to have spent a lot of time on fine tuning the algorithms. You need to buy servers, etc. Here in this bucket, in the DeFi bucket, you are providing liquidity to a smart contract. You still need to monitor a lot of things around it. It's not as easy as just sending money and that's it. But you don't need to have, from kind of the infrastructure perspective, massive upfront investment into being able to generate yield. It's quasi yield generating. And what you see in the space is that you have quite a few. It could be stable coins, it could be different layer 1 protocols that basically want to provide liquidity to their users. And with that comes kind of assurances that, look, there's enough money behind these transactions. And that's why we sort of, these funds exist. The way it works in practice, I think this is a kind of twofold. One is that you literally commit money to a protocol and do it in a really sort of agnostic or market neutral way. And then the second is you get a private deal with kind of the issuer or the creator of the protocol, which very often is done in protocols that might be a bit less big, smaller protocols, right? But that still want to grow. So that you can then get anywhere between 20, maybe up to 40%, depending on the size of the protocol, when you get it, how long is your money locked in. But that doesn't mean that these are riskless, right? There's still risk, quite a lot of risk involved, and hence you need to kind of have a curated portfolio of these quasi loans to the different protocols, so that in aggregate, your risk is minimized. But also, you need to quite often know what is the particular protocol built on. And what I mean with that is, very often, certain pieces of code are copied across different protocols, or one protocol relies on another protocol, or there's oracles involved for certain prices. And we've seen that relatively recently with Hyperliquid, for example. And so you need to be really, really, or have really intimate knowledge of the protocols, but the people behind them. What is their motivation? You need to know them. You need to, have been in the space for a while. And then finally, similar to my job, when it comes to the allocation to these different protocols, you should not be overexposed on any single one of them. As much as some of the large ones like Aave or similar have been battle tested. I think Aave has over 50 billion sort of in their smart contract. They've been battle tested, etc. There's limits to any sort of single risk factor that you should that you need to observe.
Yeah, within this DeFi bucket, I would imagine the primary risks relate to really team and smart contract risk. Is that, I mean, which kind of go hand in hand in some sense, but are those the primary risks that these funds that are taking on this DeFi strategy? Is that really it? Like, I mean, as like the number one.
So you're committing stablecoins, very often USDC, for example, and you get the reward in the native token of that protocol. So basically, there needs to be a market for where to sell that token afterwards. People will basically turn around the moment they get the tokens and sell it. If I simplify things, so what is the risk is I guess on the smart contract, basically who built the smart contract, and we've seen quite a few smart contracts basically being quasi liquidated because there was a backdoor, because they used developers, for example, from North Korea without knowing that. So that's one, and second, there can be some bug, unintentional bug, but that can either freeze the tokens or allow other people to access that. And again, there are some ways how you can protect yourself. You can, for example, look into hypernative, kind of a software layer between the different protocols and what's happening on chain, and basically creating alerts. You can protect yourself by just minimizing how much percentage of your portfolio is exposed to any of these. And ideally, you go beyond that, right? If you are RE7, Edge, and MEV, and the other teams that we mentioned, you need to be close to the teams. You need to know them. I'm not saying you need to know their wife, but very often you need to know the operations. And I think that the risk of people running away with the money is less and less. It's more that there can still be bugs in the code.
Definitely. Okay, so I would imagine that this DeFi bucket, I would imagine its performance is dramatically better when the market is overall expanding, just because there's probably more founders out there launching more protocols and more, et cetera. But I've spoken to these managers, some of these managers that we mentioned, and they've been killing it even in the years that haven't been, the crypto market has in some sense been like contracting. So how has it been, the past, we'll call it like 6 months? Has that DeFi bucket been killing it, or has it been, kind of so-so?
It depends what your benchmark is and what do you consider killing it. I would say that bucket has performed really consistently, and are able to achieve, or probably will achieve, somewhere around 15 to 17% annualized this year. So we are sort of halfway through the year, and I see some 7-8%, for example, on a net basis. Not all, but most, let's say across the board. It helps to be in a positively skewed market, and we are in such a market. But when you look at, for example, 2022, the performance was not as great. But I would say it's also, it's not just any single protocol. It also, what is your negotiation power, for example, with these up and coming protocols. So if you have 500 million, 800 million AUM, you can allocate small part of your portfolio, but that is actually much more sizable for the different teams, and so they can give you better conditions, so that you are not at 20%, but you can be at 30, right? Or sometimes even north of 30. Now, can you do it with your portfolio? No. Like entire portfolio? No. But you can sort of have these smaller bets that you can take advantage of, and hence sort of push up the price. The yield that you can basically extract from the protocols. It's buyers and sellers market, right? Where is the equilibrium? If you have an unknown protocol, but that was able to raise some money and get things off the ground, they might be more happy to pay and give like a great deal to kind of a club of 3, 4, 5 different DeFi hedge funds or DeFi funds, and even if they don't arrive at 20%, you go, okay, like who is the investor behind these funds, right? What is it that they are benchmarking against that? Are they benchmarking it as a S&P 500? Probably not. Are they benchmarking the performance versus private credit or even sort of listed credit, right? And are we talking 5 to 7%? Then if you get 14, that's great as a sort of minimum risk. And for example, recently you had Evgeny from RE7. I think that's exactly sort of where they play. They're not promising 20, 30, 50%, quite far from that. So it depends a lot, where is your money from, what is it you're trying to achieve, how diversified you are. but it doesn't necessarily equal that, if it's a bad environment, it will still be okay, or vice versa. Sometimes the best deals are done in sort of a downturn or less positive environment.
All right. So when you're looking to allocate to these few buckets at 319, what percentages does each bucket have roughly of your overall portfolio?
Yeah, so similar to not having a crystal ball of knowing where the market is heading, and I think I definitely exercise a lot of patience. And what I mean with that is it's important to understand that not all strategies perform at the same time, and not all teams perform at the same time. You need to have a bit of diversity within the different buckets, right? Because they cover different parts, even if they are in the same buckets. They can be trading across different exchanges. Some can be sort of OKX heavy, Binance heavy. Some can be Deribit heavy. Some can be on the DeFi side, more for heavy, right? So today the space is extremely fragmented. So it would not make sense to have to kind of try to take a view is that one particular fund will totally blow everybody else out of the water. And hence, I'm trying to keep every single fund more or less at the same size. Now, we are currently more over allocated to the first bucket, the delta neutral bucket, the high frequency trading, because you have decent visibility where you will end up. Every week chugs along, and you sort of have the visibility there. And that's kind of the proposition to my LPs, is that we're not there to have massive volatility in the portfolio. We're not there to call the market where the market is heading, or say Bitcoin is bad or good, etc. It's more to take advantage of all these different inefficiencies as a package. And so for now, the target portfolio is definitely sort of more or less equally allocated across the three buckets. Maybe slightly more on the delta neutral and DeFi. And then within these buckets, again, equal allocation that we don't plan to rebalance anytime soon, unless we see obviously that the strategy changed or doesn't perform at all, or the team has some basically reason to reallocate away from those.
Yeah. So when you are rebalancing, are you fully exiting funds that you're rebalancing out of, or is it, we're just going to reduce our allocation by 50% with this manager and increase it over here, and like how is that rebalancing done?
Yeah, that's a great question. So in terms of the rebalancing, so we are still in the portfolio build-up phase. So any rebalancing is, I would call it kind of soft rebalancing, meaning that we basically allocate capital to other funds, either in the same strategy or in other strategies, unless we have a proper reason, meaning where the team would significantly deviate or they would breach certain limits, both, for example, drawdown limits, but also how they, for example, handle collateral or similar things. That would lead to obviously calling the capital back. But for now, it's rebalancing. It's kind of soft rebalancing of expanding the portfolio in terms of the managers and the buckets that we track.
Very cool. So I've spoken to some folks that have some interesting setup for their fund of funds, or even, I don't even know if it's called a fund of funds, but they basically invest in SMAs versus actual funds. So why do you take the approach to invest in actual funds versus do kind of the SMA style, strategy? Yeah,
absolutely. SMA is, I see way more SMA funds or SMA teams than actual funds. I think the reason for that is that if you run a fund, you have a fund administrator, you have lawyers, you have auditors, everybody needs to be involved. If you run an SMA fund or SMA team strategy, you can be up and running much faster and sort of focus on what you're good at, which means coming up with the strategies and don't have to deal with all the admin stuff. The reason why we don't do any SMAs currently, and I think that will change next year, by the way, so a bit of a disclaimer there, is twofold. One is the collateral management, and second is the strategies that you can access. In terms of collateral management, it becomes an API management key exercise, and there are other people who are sort of way better at that because you need to handle a lot of API trading keys across sub accounts and exchanges. So if you have 10 exchanges, means you need to open an account at 10 exchanges, and not always that is something that you want to be spending your time on from sort of the admin perspective. But second, and maybe more importantly, is the returns and the strategies that you can access, right? So if you invest in a fund, that fund has the opportunity to allocate the collateral as they see fit for the most optimal returns, and that can be both across CFI and DeFi. And it would be more difficult to replicate that if you run SMAs with them. But also, when you look at the returns of multi-manager SMA accounts, some of them worked quite well last year, but over the past 12 months has been kind of a mixed returns. So it doesn't necessarily hold up to the value or to the proposition is that you can find and discover these small managers who are top traders and top quants, but just haven't grown in scale and hence sort of generate extraordinary returns. That hasn't been the case. And look, I'm sure there are some SMA sort of platforms that are able to generate some crazy returns, I don't know, 30% a quarter or similar. But at least the ones that I know, it hasn't necessarily stacked up. It stacks up when it comes to your collateral management because you keep the collateral, but it means your cybersecurity also needs to be significantly more advanced, and you need to monitor certain things very differently than when you monitor them as a fund of funds. So I do give the credit where the credit is due in the sense that both models work. They work quite well. And we sort of chose to pursue the fund of funds model rather than the SMA model because of some of the shortcomings there.
How many, in an ideal world, let's pretend, you're at the exact AUM that you want to be at. In an ideal world, what is the number of funds? Well, I guess with this SMA, question here, it's kind of funds and SMAs that you would be actively investing into. Like, what is the ideal perfect number?
Yeah. I think it's around 10 to 12. That's at least where we're heading for the next 18 months. I don't believe you need to be at 50. I think the reason goes into exactly what I said earlier is that maybe diversification in that case is actually kind of has a negative impact. Obviously, even, when you run 50, probably is not 2% in every single fund. There's more skewedness and significant concentration among the top 3, top 5. And in a way, hence it behaves like a fund of funds. You just see a bit more ideas. But I don't think also you need to have 3, 5. You need to monitor all the risk factors. What is your counterparty risk? We haven't spoken kind of about the operational side much, but when you think about any single vector that can be a risk, it can be counterparty risk. It's just simply how many have you invested in, right? Where does the money sit in terms of collateral, like across exchanges? How much is it in off-exchange settlements and off-exchange sort of custody? Banks, right? Bank is these days is a risk factor. Not necessarily that they will sort of take your money, but they might freeze the account, right? Until sort of, I don't know, clarifications come forward or whatever. So on our side, we need to monitor these risks. But I do give credit to the different teams is that they should allocate the capital as they see fit into the opportunities. And they should do that sort of independently. They are in the first line. They are the experts for it. And if they see an opportunity at a particular exchange, if that fits their risk metrics and my risk metrics, then by all means, right? And if I sort of keep the money with myself in an SMA sort of type of platform structure, then I just might be slower to react to some of these changes.
All right. So this is going to be kind of a fun one. If you had to choose one of these buckets that you believe has the most growth potential or just alpha generation potential for the next 3 years, which bucket would you choose?
Tricky one. I would probably hesitate between the short-term directional, the multi-factor models, and the DeFi. The reason why I'm not mentioning delta neutral because I believe it's just going to get more and more competitive, despite the sort of growth in products that you can trade and venues that you can trade on. It will just become more competitive. But where I see you can have a proper outperformance if you manage, again, the risk correctly is your multi-factor models, and it's potentially the DeFi space. Even the DeFi is coming under pressure, right? So maybe by elimination, it would be the middle bucket, short-term directional, where you trade based on models, both sort of linear, right, as well as options.
All right. So touching quickly on the market neutral, if the future plays out how we hope it will, where we have NFTs trading, with collectibles and video game items. There's 3.5 or 3.1 billion gamers worldwide, and they're all trading digital swords and whatever. And on the other side, we have tokenized securities of real estate, and so there's just a massive 100x explosion of assets being traded on chain. Wouldn't that, just by nature of it, kind of its size, even like Citadel and Jane Street and whatnot, they wouldn't be able to handle all these different venues and all these different sub niches? Or do you believe that, like, with that infrastructure, no, they can trade across all these different types and areas?
So it's a very different world, and basically you cannot sit on two chairs. And what I mean with that is all we have spoken about is quant systematic, which means you're using algorithms to come up with what you think should be the trade. What you described, that means that you need to do a fundamental analysis of what is the actual sort of value of it, right? So if you have tokenized hotels, real estate, equities, you need to somehow come up with what is the right value for that. And just because it's tokenized doesn't mean that you know what the value is. And so, someone can be selling something somewhere for X, and how do you know if X is overvalued or undervalued, right? There needs to be some sort of reference price. So if you have the reference price, then you are back into systematic. And in that case, I fully agree with you. But if we are talking about, Pokemon cards and there's no sort of reference to it, then you are trading basically based on, again, your crystal ball. And that's not the world where I can tell my LPs, we're not going to see drawdowns in these strategies. So that's where I will draw the line, is between sort of the fundamental discretionary investing and actual investing, let's say, and more on the trading side, the quant systematic side. Because otherwise, you need to pick and choose. You cannot be everywhere. The large guys, obviously, they will have teams everywhere. And, at some point, they might sort of just try to trade something. But also, how scalable is that, right? One day you will trade, or your algo will try to trade Pokemon cards, and then a hotel in Aspen. I don't know. It's not. I don't see the liquidity there to be enough for a lot of the teams to really spend a lot of time. Again, with exception to products that have a reference price somewhere else. So tokenized equities, right? You can very easily imagine to be trading actually both legs on CME or Nasdaq or NICE to wherever is listed on Binance, etc. Yeah.
Very cool. Makes sense. All right, I want to dive into the diligence process. So when you're talking to different managers, could you describe to me what are some? Because I guess it depended on bucket, but you can kind of make up the example as we go. What are some of the factors that you're looking for when you're talking to these managers? Is it purely show me your numbers and then we can talk more, or is it more personality driven, or where they're located physically? Like, what are these factors that you're looking at when you're starting DD?
Yeah, that's a big question. How much time do you have? So I think, look, it definitely starts with a quantitative side. What I mean with that is the returns. The returns, it's your business card, right? If the returns historically don't stack up, then what is the question today, or what is the view that they will stack up in the future? And I don't mean that they are bad, but it just does not fit the portfolio. So what I mean with that, right? My portfolio, the composition across the different funds has a particular profile, returns profile in a given month, drawdown profile, but also correlation profile, right? The different strategies, how they correlate with each other. And ideally, you want a really portfolio that is uncorrelated, both sort of as a portfolio with the broader market, but also the different strategies. Now, pause here. You obviously want to make money at some point, so it cannot be sort of -1 uncorrelated or whatever. But when I sort of see a new fund or a lot of these SMAs, it's relatively easy to just plug in their returns into my sort of template and see, okay, do I have a similar fund that performs similarly or does similar trading, has a similar trading style or not? And if the answer is yes, then probably it's still good to speak with people, what they're doing, how they go about it, where they're heading. But it might be much more difficult to sort of add a second fund into the portfolio if they do the same thing. Now, they might be doing the same thing, but much better. So in that case, actually, it makes a lot of sense to flip that, right? They are not correlated to the portfolio. They are not correlated to S&P, to Bitcoin, even though that should not necessarily be the benchmark. And in that case, it does make sense. So the first one is quantitative. We look obviously at returns because just simply it needs to make sense to put it into the portfolio, but also how volatile these returns are. So if you claim you're delta neutral and you have -5 one month and +5 another month, then it's tricky. It just means that maybe you're doing something else that from what you're doing. There are funds out there that have reasons for having a massive outperformance, but maybe because mark to market certain things means that the next month they will be, they were +10, they will be -5, for example. And then you need to take a view, okay, at what point do you come in? You need to have a proper discussion. So first one, quantitative. Second one is on the qualitative side. And that's where there's more art than science, right? You want to look at the profiles of the people, where they have worked before, how they approach problems, but also how the team sticks together. Do they just hire random people, or do they have some common glue that means that they are from the same culture, for example, right? Or they have the same, I don't want to say education, but the same career upbringing. They worked for 10 years at a particular bank, so they are on the same wave type of thing. It's not bulletproof, but I visit all the managers. I speak with them, see them in person, and I track them over a longer period of time rather than sort of simply go and allocate because they have a crazy return. No, quite the opposite. The way I choose the funds where I invest, quite frankly, I want to see that what they have done in November 2022. So when FTX happened, how did they react to it? Number one, did they have money there? And that's fine if they had money there, right? But did they have 90% or did they have 15%, right? So that's, I think, is key. And second, what has happened, basically? What is their story? Maybe they withdraw money straight away because they heard about it. Maybe they left it there because they trust it. Maybe they were actually able to generate much more profit on trades on a different exchange and sort of counteract any negative performance. Did they have to shut down and now they're restarting, right? What has happened? And kind of nearly it's going to be 3 years. So this is what I'm sort of saying. We're looking at funds that have been around late 2022. That probably is 3 years of history, trading track record. It means that quite a lot of the teams, quite frankly, we cannot allocate to at this stage. Maybe next year, maybe at some point later. But in the fund is my money. It's third-party capital. And you sort of managing from kind of the fiduciary perspective, managing third-party capital is quite a big task, and hence we're not taking shortcuts on that. Usually the teams that we allocate to, they have 3 to 8 years, probably 100 million to $1 billion AUM, and they have up to 150 people. So some of them they are massive. So we're taking a bit of a low risk, low return approach. I would probably trade 1 unit of risk for 1 unit of return any single day. There's different ways how that can be done. But yeah, compared to some other, we might be a bit more on the lower risk, but still presenting great returns to the LPs.
When you're looking at their returns, what is the benchmark for each one of these sub strategies? Like, is the benchmark for market neutral different than the DeFi or different than the directional, or is it kind of, do you create your own benchmark that you're using, or how do you view that?
Good question. So you need to both look at returns as well as the drawdowns, right? So if someone comes to me and says, look, on the delta neutral and on the DeFi space, we have drawdowns, I don't know, -5% in a month, then that just does not fly, right? You should not have such high drawdowns in any given month, and hence it would not fly. If someone comes to me with the same profile in market neutral, kind of long short, it should not happen, but it's not end of the world. I know by definition, long short can be just much more directional, is much more volatile. So there it has kind of its own metric based on the strategy, right? That you trade. In terms of the returns that we're aiming for, we're aiming 20% plus for our LPs. That means that you should be doing 25% probably, regardless which bucket you are in. I think that, and you have spoken to quite a lot of managers, this year is more difficult than last year's. Last year was, a lot of the teams achieved 25, 30%. Some those are neutral, even way more, above 40. Depends, how clean these numbers are. But basically, last year's have been basically better. This year, I think a lot of the funds will arrive maybe to 15% across these three buckets. I think 15, 20, 22 maybe, something like that. So that's sort of what we're aiming for. We're not aiming to present 20, 30, 40%, but equally, at 10%, the risk is perceived by the LPs to be significantly higher than what it's worth. And what I mean with that is crypto these days on the trading side, especially on the market neutral, has limited upside, perception of limited upside, unlimited drawdown, right? I think we all agree that's not the case, but that's the perception. And so you need to be still presenting attractive returns. And if I can deliver 20% any single year, then it's happy days, I think. And finally, what I haven't mentioned yet, we have both US dollar share class and BTC share class. And I think for people who want the directionality, look, historically, a lot of alts in 2017 would totally blow Bitcoin out of the water. Same for maybe when we had the Solana mania around meme coins, etc. But I think going forward, that's not going to be the case. And so I think if people want to express directionality, then why not, and are basically long-term believers in Bitcoin, then why not invest in a Bitcoin share class where you get the outperformance on top of Bitcoin, so Bitcoin on Bitcoin, but you keep the directionality there. I think that has been definitely over the past 12 months or 18 months much better trade than to sort of be trying to get the directionality from selecting certain altcoins or more recently the digital asset treasury companies, etc. But look, we also don't impose the view on LPs. We're there to educate. We are there to show things, opine if we're asked. But ultimately, if they want, USD share class, then that's great. If they want BTC share class, that's great. But a lot of the people that I speak to, we are probably their first crypto investment that they do, and hence it's more of an educational type of discussion.
How popular has the BTC share class been? What percent of LPs are headed in the BTC share class direction?
Good question. I think it's the USD is higher in terms of AUM. I would say maybe 1 out of 4 people would be looking at the BTC as well.
That's pretty good.
Yeah,
it's pretty good. Yeah, I feel like, I don't know. I'm also such a maxi, and I'm sure you are as well. But it feels to me like kind of Bitcoin capital markets just in general are going to expand dramatically, and there's going to be number of corporations in the future that are going to be dominating a lot of their reporting or kind of performance based on BTC and funds, especially. I think that's going to become exceptionally popular over the next few years, like much faster than we all probably perceive. So having that BTC share class, I feel like is essential because it's going to become kind of the standard. Right now it's still pretty niche, but I feel like in 5 to 10 years it's going to become like the absolute standard.
To me, Bitcoin is in a way cost of money, is the benchmark. As much as I think we're early, and I still obviously count dollars rather than Bitcoin. But in terms of sort of new investment opportunities, if I believe, or I do believe that Bitcoin will be the kind of the store of value, will outperform or will grow way above gold, and I think that we will see some crazy numbers in the same way that when I was buying Bitcoin in 2000, I thought 100K is a crazy number. I think it will become kind of the currency of denomination or the unit of measurement. And if you can basically persuade your principal or yourself to allocate even smaller portion, then I think it's worth it. But I let everybody do their own choices. As people say in crypto, everybody gets Bitcoin at the price they deserve. But I do believe that we're heading way higher, and it's not way higher. Sorry, as in it's way higher. But I also want to pause on this, right? Like, I think this is really the first time in history where even the mental models need to change of people when it comes to what is money, what is actually money. I think that it's kind of everybody's responsibility to be curious, and just because something is different doesn't mean that it's bad. You need to learn about it. You need to educate yourself. And so, spending a lot of time reading.
Yeah, it's once if basically you're talk to your principal about maybe going into the BTC share class, it's like if you're going to make the bet on crypto anyways, you might as well do the BTC class, because it's like, hey, but we might as well go all the way there. And yeah, as you mentioned, it's kind of like the cost of capital, and going to be the standard in some sense, which is an incredible thing to say. When we first got involved in this, it's like, yeah, maybe, hopefully one day, but probably not. And now it's like it's like more certain, which is pretty incredible. But yeah, no, it's very, very fun stuff. I want to talk more about the kind of the high level questions shortly. But going back to the fund sizes, you mentioned 100 million to $1 billion is kind of the fund sizes that you're looking at. Have you noticed a huge difference, or even some small difference in performance between a $1 billion fund versus a $100 million fund?
Absolutely, yeah. It's kind of nearly inverse correlation. Bigger funds have way more money to manage, and it means that across the different strategies, it becomes basically more competitive, and the returns go down. So it's not one for one, but I would say that's kind of the general rule, right? So if you have $1 billion, you need to do different things than when you have 100 million, or if you have 5 million. The best performance you will see is in the smaller funds, because clearly they can access additional leverage from exchanges, and even basically with a small AUM, you can percentage-wise demonstrate really, really nice returns, right? While sort of still sticking to your core thesis of being delta neutral, for example. The moment you pass, 200, 300 million, and especially once you are at 500 or $1 billion, if you're doing delta neutral, becomes very tricky, very competitive. You will not be able to do as much as a sort of rule. In terms of the long short, there it's tricky to I would say argue, right? Because the more money you have, the more you can kind of afford to pay your research staff and have bigger research staff, and the more you can go and basically not be constrained by the capacity, because you're not rebalancing your portfolio so often, maybe, or as much needed, right? Basically, you can rebalance only every 15 minutes, couple hours, depending obviously of how big your fund is, but you're not constrained as much by the size. So there maybe, I'm trying to think of the companies and funds where we allocated that would be pursuing that. I think the jury's still out, to be honest, on that one. In terms of DeFi, that's also a tricky one, right? So what's happening there is a lot of the teams are chasing yield, right? You need to chase for the 30, 40% type of deals, the private deals that you get, but you still can't allocate too much to them because your core might be, or basically you don't want to be overexposed, but you have more scalability there potentially, right? If you find one good protocol, you can deploy quite a lot of your own capital there. And so the scalability is there, and it's sort of yield nearly assured from trading perspective, scalability. And so I would say the DeFi, there's competition for it, let's be honest, but that one might still scale. You can still go from 500 million to $1 billion, right? And we've seen some funds that have grown, they 2x their AUM just this past 6 months, right? So some people grew massively, and they obviously started in SMA, they do fund, now they do vaults. So different ways how to access the capital. But I think that overall returns are coming down. And maybe, look, it's for the right reasons. Yeah.
So how do you define the primary source of edge for these different managers? And, maybe for like the market neutral guys, it's some sort of tech advantage. They have really, really good technology team that can build out this great infrastructure. Maybe for the DeFi folks, it's like an access game. Maybe for the directional, it's like data. Like they have really great historical data, and they can kind of build these models. Like how would you define the edges or the advantages that each one of these managers has within these buckets?
So on the delta neutral side, I think technology matters more and more, and the time in the market. So basically every year you make small tweaks, or every week you make a small tweak to your algo, better routing, different execution. You add, a small piece of to the code, and suddenly like it executes better or faster. And that means that you sort of uncover more inefficiencies that you can trade without sort of taking extra risk. So I would say the edge there is just simply the number of people that you have that you can throw at a problem, and how tech enabled they are, how long they've been in the market, how experienced they are. On the delta neutral, kind of the long short space, I think, or at least what I see, is that people are not building algos just to trade, but people are building algos that then go and develop algos, or AI, basically using AI to come up with different strategies that then can be backtested, can be, double clicked on. But ultimately you will be running hundreds, if not thousands of algos. Gone are the days when you could do something, correlation analysis in Excel and call it an algo. These days you run big stacks in AWS to come up with these strategies, right? So I think that's where the world is heading, is that you also need more resources. You need to be way more experienced in just managing your research infrastructure, run servers in AWS, basically. That's what it means. And then on the third one, that's a bit particular, because the edge there is being close to the founders, basically really having ears on the ground and hearing what's happening, who's building what, because then you can go there and you can be their partner for scaling up. And that means you also get a preferential deal. So there are some funds that doing that really well, and we spoke about those, where they have they have people. So at the end of the day, it comes down to people. There, if you develop the relationships, you will become the go-to partner for them, and that means also you can command higher yield from the smart contracts.
I'm curious I've always thought about this. Are there, maybe not, but qualitative or personality traits, like some qualitative metrics, or some traits that these managers have that you look for? Because obviously like returns and the volatility and you kind of have these other like quantitative factors. But what about when you meet them in person and you're like, man, they're a 10 out of 10 in all these quantitative factors, but they're a total asshole on the the qualitative personality metrics, therefore I won't allocate? Or like how does that come into play at all, these personality traits?
No, it does. Simple answer is it does. Again, everybody comes with a different package, but I want to see people who have a chip on the shoulder, who are hungry and they have a reason for it. They are there to do something and prove someone wrong, if you want. Very often it's kind of the underdogs, right? People who just came from an environment that didn't favor them in whatever shape or form. Could be different nationality, could be country, could be some, I don't know, something like that. Everybody has a story. And I think that matters a lot. Like, as in, I would not over-index on that, but I want to understand the person. And I don't mean it like bad. Like, if you had a total normal upbringing and went to a normal bank and then you started to trade crypto, that's totally fine. But tell me, like, why are you motivated? Like, why are you going to be doing this in the next, not just 1 month, but in the next year and the next 5 years? What motivates you? What drives you? So in hiring is the same. What is the driving factor for the person to join you? And I think this is like an extended team, right? I want to understand their motivation, the reason why they're doing what they're doing, and how they will react when things don't go as well, right? So when things are good, when things are bad, this too shall pass. And so understanding like what will happen. So there are obviously factors you can check and etc. But sitting down with them, eye to eye, going out with them, see how they behave, how they treat the waitress, right? All this plays into consideration, because the number tells you only one story. But you need to sit down with the people and see what is it they're building and the motivation behind it.
Very cool. All right. So would you say that we're in like the currently the golden era of crypto hedge funds, or, is that like, are we just starting the golden era? Are we in the middle of it? Are we towards the end? Like, how would you, if you had to guess, like where are we?
I was joking the other days that crypto's not going to go bankrupt by lack of funds, like hedge funds. I think we are at the beginning of maybe a golden era. And what I mean with that is, or we've never been in a better position. The amount of collateral that you can have off exchanges and really focus on the trading risks, right, has never been greater. There's different off exchange custody solutions and settlements. You have Copper, you have Zodia, you have different, custodians that basically help you mirror the trading on the different venues. So you can kind of take one thing away. Simplified, right? One factor away. And so from that perspective, even people who before were working in a banks and were considering it, like they can suddenly start trading, right? They can go into some small SMA platform and see if they perform well, and they can scale from that. And so I do believe that we are at a kind of a golden era, probably might be a good example, a good description, but where suddenly like it unlocks a lot of potential that previously was not there. Crypto became accepted sort of way how to make money, and I think that especially people who don't necessarily want to go and work for a super large bank and trade, S&P 500 options, can suddenly do a living in this space. Yeah, absolutely.
All right, Bob, what is the grand vision for 319 Capital?
Ooh. So step one is what we're building now, right? We're building a product where people don't have drawdowns, investors don't face massive drawdowns, and if anything, they know that we are there, it's predictable, and it's liquid. Like, we're not taking your capital hostage. Step two will be developing a broader platform and helping investors think about their investments more holistically. And what that means is, I think, having all your money in market neutral, I don't think it makes sense, right? But we want to be there and do a bit of hand holding when it comes to our investors, to be the guys to tell them about Bitcoin, to tell them about directionality and how to think about that. And I think what the future holds is be much more larger, more diversified asset manager for our partners and investors. But the delta neutral and market neutral space is a great place to start because, as I mentioned, no one likes drawdowns, and you need to know what you're buying.
Amazing. Bob, I cannot believe it's already been an hour and 17 minutes. That's crazy, but it is time for the closing questions.
Ooh.
All right. Price of Bitcoin in the next 12 months. This is personal views only. We're just having fun. What do you think the price of Bitcoin will be in the next 12 months?
Yeah, you're putting me on the spot here. I'm gonna go with 180,000.
Ooh, I like that.
180,000. So not crazy number. I think it's achievable.
Respectable number. I love it. All right. What trend is overhyped and underhyped within the crypto sphere or crypto asset management sphere?
I would say underhyped is what Bitcoin means for people. And what I mean with that is how people think about money, and especially separation from state. I don't think anyone, and I hope I'm not going to get canceled for this or the interview being taken down, but I think it's underhyped how Bitcoin can impact someone's sort of personal liberty and mental liberty. Absolutely underhyped. I think we sort of very quickly focus on the number. Overhyped today, the Bitcoin treasury companies, I think, digital asset treasury companies. I see why obviously investors are looking after that and running after that. And I see, and I know, and I have research why they can outperform the price of the underlying because of, a relatively simple mathematical formula. But I think that just the amount of attention these days is probably unnecessary to have 20 different Bitcoin treasury companies just in the US. I think a lot of people also need to separate them into different buckets. Just if you're just buying and holding, versus if you're doing something with that. So overall, I would just say know what you're buying. Like, it's fine to buy digital asset treasury companies, but understand at what point you're coming in and what is it that you're doing with the underlying.
Love that. All right. What is one piece of content, whether it be a blog, book, podcast, etc., that had major impact on your life?
Very recently, I actually read a book from Hayek, The Nationalization of Money. And it sort of goes, in the direction of what I mentioned earlier, what Bitcoin does to one's mentality. Because the main premise of the book, spoilers here, is questioning why state should be the one issuing the money. And again, I think everybody should read it, think about it, learn about it, but at least start to question things around yourself. I think is a great one. So yeah, it's not a long book, maybe 150, 160 pages, but a lot of thinking that it made me.
Amazing. All right, Bob, where can people learn more about 319 and yourself?
Absolutely. So 319capital.com, and just reach out on LinkedIn or through the website.
Amazing. Thank you, sir.
Thank you so much, Andy. I appreciate it. Have a great day.